Hello, class. Our first lecture is going to be on Chapter 1. And the first learning objective we're going to take a look at is going to be the purpose and importance of an accounting. And specifically with financial accounting, we're building towards preparing reports such as financial statements. And this is going to start with identifying an underlying economic transaction and then recording that transaction. Now, while doing this, we need to keep in mind that we're preparing these financial statements typically for external stakeholders. And there are other opportunities within accounting that are going to have different purposes. One, which is a course that you'll see later here at Lindenwood, that's for managerial accounting, and this focus of that type of accounting is going to be more towards internal stakeholders, so more towards like your CEO, CFO, project managers. The external stakeholder focus in financial accounting is going to be more towards shareholders and bondholders and folks outside of the business itself. You've also got tax accounting, where the focus is going to be on preparation and planning for actual payments of taxes and how much is going to be owed for that purpose. Looking at the external stakeholders, again, not just shareholders and bondholders or lenders, but you're also looking at the board of directors, regulators, and external auditors. So that's going to be if in preparation of the financial statements, if a company wants to have an auditor come in to review what's been done, that's going to be an example, your external auditor, and those typically can be like a PricewaterhouseCoopers, Deloitte, Ernst & Young, KPMG, and then there's a myriad of others that fall into that same category. Again, for internal users, something that might be more of a focus of managerial accounting, although you can use financial statements for that purpose as well. You're looking at internal managers, so CEO, CFO. Here we've got listed different managers within those different purposes, such as purchasing, human resource, marketing, and production. So an important thing to note for financial accounting was the passing of Sarbanes-Oxley for 2002. Now, accounting existed before Sarbanes-Oxley, but this created a very different environment for accounting. Specifically, you had CFOs and CFOs requirement to sign off on it. You had documentation and verification of internal controls now being required. And where this all started was different accounting fraudulent events that had occurred. Most notably was Enron, who what they had done is mischaracterized different accounts that should have ordinarily be listed or thought of as liabilities, and were instead listing those as revenues. Both are credits, but that was something that they engaged in that was found to be something that was not completely ethical, and Congress wanted to put these kind of rules and regulations in place to help curtail that in the future. Another example of it was WorldCom, whereas Enron was more on the credit side. WorldCom was on the debit side, where they were categorizing something that ordinarily would be thought of as an expense, as instead capitalizing it as an asset. So still listing, both these companies were listing their credits and debits, so including them in the financial statements, but the categorization of how they were including them was something that was aggressive at the least. So when faced with something like this, whether categorizing an account or a transaction as being an asset or an expense, or being a liability or a revenue that's going to impact your equity, then the steps you want to go through is, one, identifying, hey, is there any ethical concern here? Analyzing what the different options would be and considering them both, or considering all of them, and then making sure to consider the ethics when making that decision. So the next thing we want to take a look at for our learning objectives is going to be the generally accepted accounting principles. Now, there is also something called IFRS, which is used outside of the United States, but this course is primarily going to focus on GAAP, which is going to be those generally accepted accounting principles. And the focus here for that is going to be to have accounting information that is relevant, reliable, and comparable. And we're going to have 4 principles we're going to look at in that. The first is going to be the measurement principle, and that is going to be historical costs that we're looking at for what we list as the values. And the reason why we're going to look at historical cost is that it's objective and verifiable. So we may disagree in terms of what a certain asset or certain item is worth now. For example, a piece of equipment. We may one person may think it's worth $1,000, another person may think it's worth $1,500. But the one thing we can't really disagree on is what was paid for it. So if $1,000 is what the piece of equipment was purchased at, we can all agree that objectively $1,000 is what that historical cost is. So there's a less of a chance for disagreement as far as that goes. Now we may have something in place such as depreciation to reduce its value over time to account for wear and tear and that kind of thing. But for its initial listing, that constant principle is going to look at the actual cost for the historical cost. The second thing is going to be something called revenue recognition principle, and that's going to come into play in terms of when is that revenue actually earned. And what we're going to consider is when the company performs its part of the transactions and has completed that. So even though the money may change hands either before or after the transaction, revenue can be recognized or included in those financial statements as earned revenue when the transaction occurs on behalf of the company. And we're also going to want to expense those costs at the same time as we are recording that revenue and recognizing that revenue. And that's going to be what we're going to refer to as the matching principle. So for example, if we are selling a cup of coffee, even if a customer comes in ahead of time and says, hey, I'm going to prepay and maybe on a gift card or on an app and give you money ahead of time for the coffee, or if they just ask, hey, I would like a cup of coffee, but I can't pay today, I gladly pay it tomorrow, and want to put it on their tab, as it were. The day in which the actual coffee is provided, the customer is going to be when that revenue is going to be recognized. The matching principle is going to say, well, we also want to expense the cost that we may have put in for the cup that we're holding that coffee in, the lid that goes on it, and then the water and beans that make up the coffee. We're going to want to expense that for the cost of the good that was just sold at the same time as when we're recognizing that revenue. And then the last principle here is going to be a full disclosure principle, in that we want to report the details behind the financial statements that's going to impact users' decisions, and we're going to do that. One way that we're going to do that is through the notes in the financial statement. We'll see more about that later on in the class. So when we're recording these transactions, we're going to think about the accounting equation. Now this is going to build towards the balance sheet, which is one of our financial statements. And we're going to want to recognize that our underlying economic resources are going to be what we think of as those assets. And that's going to always balance with the sum of our liabilities and equity. And even though it's not strictly going to be thought of this way, one way we can think of it is the assets are going to be those underlying economic resources, and our liabilities and equity are going to be how they're funded. So they're either funded with shareholder money, that being equity, or other people's money, people not the shareholders. Those are going to be liabilities, and that may be a lender, so a bank if the company were to go out and get a loan. It may also be something along the lines of a supplier. If we were to purchase equipment but say, hey, we can't pay today, we gladly pay tomorrow, we're essentially borrowing from that supplier. We're going to take a look at a few different transactions here to see how they're going to impact that accounting equation. Again, remembering that we always want that to remain in balance. So the first we have here is an investment by the owner. So we have an individual that's going to put $30,000 of cash into the company. So the first account we're going to look at is going to be cash, which is going to be an asset. And then we're going to want to balance that somewhere. So if we were on the left-hand side of that equation, we're increasing cash. Here, we're going to have an increase in equity as well, which is going to be on the right-hand side. The second transaction we have is going to be a purchase of supplies for cash. So we're going to have a decrease on the asset side to cash, but we're also going to have an increase on the asset side of those supplies. So this is also what we might think of as a transformation of assets. So we're going to transform one asset, cash, into a different asset, supplies. So there's no change that's needed on the right-hand side of the equation, no change to liabilities or equity, but we are changing the type of asset that we've got. So our third transaction is going to be a purchase of equipment for cash. And we're going to again have an impact to cash and an impact to equipment. Here we're going to have a decrease in cash as the asset, and we're going to have an increase in equipment as the asset. So the fourth transaction we have here is going to be a purchase of supplies on credit. So here we are going to involve both sides of that equals of that equation. We're going to have a purchase of supplies that's going to increase that asset, increase supplies. And we're also, because we're essentially borrowing from the supplier, we're not paying the supplier right away by putting it on credit. We're going to increase liability, and we're going to call that account here accounts payable. So we're going to have an increase on the left-hand side of the equation and an increase on the right-hand side of the equation under liability. So our fifth transaction is going to be providing a service for cash. And here the example is going to be a consulting service. So we're going to have an increase in cash as an asset. And we're also going to book revenues, which is going to ultimately increase equity. Now, if we have a payment of expenses in cash, we're going to involve cash as the asset, which is going to be a decrease to that asset, decrease to cash. And then we're going to have an expense, which is going to be an increase in the expense, which is going to ultimately decrease equity. So it's going to take away a portion of that revenue that ordinarily would be increasing in equity. So the expense itself will decrease equity. So we've got a decrease on the left-hand side of the equation and a decrease on the right-hand side of the equation. And similarly, the same thing for salaries. We've got a decrease in the cash on the asset side, the left-hand side, and a decrease in equity on the right-hand side. So the next transaction, we've got providing services and facilities for credit. So here we're providing consulting services and rent the facility to a customer for credit. So the accounts involved is going to be accounts receivable, which is going to be a different type of asset. So this is going to be one in which we are owed money from the customer because we're providing those services to the customer on credit. So we're telling the customer, hey, you don't have to pay us today. We'd gladly accept payment tomorrow. Accounts receivable is an asset we're using to record that we anticipate being paid at that later date. And then because we're increasing an asset on the left-hand side, we need to have a corresponding change. And then that is going to be to equity because of an increase in those revenues. And we're also renting those facilities to the customer, which is going to be rental revenue as well. So that's going to be an increase in equity. So our ninth transaction is going to be receipt of cash for the accounts receivable. When we made that transaction, we said we'd gladly accept payment at a future date for what we were providing today. Here's that future date in which the customer is going to pay money on that accounts receivable. So we're going to have an increase of cash as the asset on the left-hand side, and we're also going to have a decrease in accounts receivable, so stay on that left-hand side. So the next transaction we have here is a payment of the accounts receivable. So this is where we purchased maybe supplies or equipment from a supplier, and we still owe money to that supplier. So we're going to have a decrease in cash as we make payment, and a decrease in accounts payable, so a decrease in that liability or what we owe remaining. So the next transaction we have is going to be a payment of cash dividend to the owner. So this is going to be a decrease in cash, as that is going to leave the company, and the increase in dividends is going to be a decrease in equity, as we're not going to have money in the company that's on behalf of the shareholders any longer. That money has been returned to the shareholders. So the next learning objective we're going to look at is going to be regarding basic financial statements and explaining the interrelation. So the accounting equation is going to be listed here on the third. The balance sheet is primarily what that's going to build towards. So that's going to include our assets that was on the left-hand side of the equation, and the liabilities and equity that were on the right-hand side. We're also going to have to build out an income statement, which is going to include company revenues, as well as the expenses, both for the cost of the goods that might have been sold, as well as maybe periodic expenses such as rent of a headquarters building or something like that that may still occur. The other two financial statements we have here listed as 2 and 4. One is going to the first one is going to be a statement of our retained earnings. So that is breaking out how um, those retained earnings are going to be assembled. So looking at the different changes that we're going to have over that period of time. And then the other one is going to be a statement of cash flows. So identifying primarily whether the cash flows are going to be for operations, financing, or investing, and then looking at the inflows and outflows over that period of time. All right. And then we want to look at a different measure for how we could use to interpretate and maybe glean some intuition from this accounting information. The first one we're going to look at is going to be return on assets. So as a financial analyst, you may look at the information that's presented for net income on your income statement, and then total assets on the balance sheet, for example. And it may be something that begs the question of, so is this good or bad? And I do want to emphasize that you can't necessarily tell in a vacuum with only one number. But if you compare some of these measures against maybe similar companies, or if you compare them against themselves in prior periods, then you can get a sense of, well, are they better than the similarly situated company, or are they better than they were in the past or worse than they were in the past? The return on assets is going to give us some measure, some gauge in terms of how managers are doing in terms of generating income for shareholders based on a given set of underlying economic resources, here average total assets. And what that average total assets is referring to is we may not have an asset number at the beginning of the year and the end of the year, but we know net income's over the course of the year. And we want an asset number that's going to try to match that period of time. So what we do have is we have total assets at the end of this year, and we can use total assets at the end of the previous year and use that as the beginning of the year number. So we're going to average maybe the prior year total assets and the current year total assets to get an average number that's going to let us know over the course of that period about what were our total assets, and then net income occurring over that period as well. And then that's going to give us some measure of their performance, how productive those managers were, and how profitable they were for our shareholders. And here, just as an example, we've got Nike, who currently has a 19% return on assets, which is going to be better than the 17.5% and 16.3% it was in the previous year and 2 years ago. And we've got an Under Armour, which is at 7.9%, which is a little worse than it was a year ago and even worse than it was 2 years ago. So one thing we can say from an analysis standpoint is that Nike seems to be increasing, their managers seem to be increasing the amount of return they're able to generate on average total assets, while Under Armour is decreasing the amount of net income that they're doing over that same period of time for a given set of underlying economic resources or total assets. And this is going to conclude Chapter 1.